we are joined by none other than Leclair and Sam Rule from the Bitcoin Magazine Pro Team. Gentlemen, how goes it out there, both in your personal lives as well as in the markets?
What's up, Q? Sam, how are we doing? Doing good. Had a fun weekend. Happy to be back in the saddle, watching this boring chop. But no, I'm good. Sam, how you doing, man?
Hey guys, doing good, man. Also good weekend. Was actually outside, not really on the charts. Pretty boring in terms of price action relative to like what we got before. So a lot of chopping, a lot of ranging, catching up on a lot of macro and kind of market stuff this morning. So, feeling bearish still, but good overall.
So what are you guys paying attention to right now? We have CPI coming out in a couple of days. Incessant contagion continuing to spiral out over in Bitcoin land. And then, of course, we got Fed rate hikes in about 2 weeks.
Yeah, I mean, we've focused a lot of our time and effort in the last month on the contagion stuff. We still are kind of the opinion that there are potentially some more dead bodies that have to float to shore. No inside intel kind of on that just in particular, but it just kind of what we've heard, what we've seen, and how long it took post Luna for, along with the price action going completely down. But it just seems that there's, a high likelihood, in my opinion, that there's still kind of some more unsecured credit out there, or whether it's unsecured or, loans outstanding or balance sheet impairment, all this stuff. I think there's a potential for some more pain, and that's not even really talking about the kind of the macro stuff that we've, I'm sure everybody has heard about ad nauseum since the start of probably Q1. Why are we monitoring CPI inflation when inflation is already known? Well, that's just the reality of how Bitcoin is traded as an asset today. And you can choose to ignore that, and that's the beauty of it, and you can stack. But, the exchange rate is very, very dependent on all these macro variables. And I think, in that sense, we still have a good ways to go before we are back in bull market up only mode. But I think Sam and I are in agreement there, but would like to hear his thoughts as well. He wrote a pretty good macro piece on Friday.
Yeah. I mean, Dylan are pretty aligned. I mean, in terms of like what kind of looking at just from like a macro data perspective, the jobs figures for the United States for the month of June were pretty interesting, kind of like a surprise to the upside, same as May, like a huge surprise to the upside, which is another good indication that we've talked about recession being this contracting 2 quarters of GDP growth, but unemployment being a big part of that. So that essentially, we've yet to see unemployment kind of turn over. And that the Fed's saying, hey, we want an unemployment rate essentially over 4% and that demand destruction coming in. So that's, kind of seems like that is the next dynamic or like shoe to drop and unfold over the next 6 months. Same with Q2 earnings. Got some Q2 earnings that are going to be coming out today. I think mostly some of the big Q2 earnings come out later this week and then the couple weeks that follow. So I think that's also going to be a big macro kind of point to watch in terms of, what I think Dylan and I both think of that, earnings estimates seem to be relatively pretty high across like consensus and analysts and those are kind of next to fall. And that's a lot of pressure in terms of like more of a profit earnings recession starting to play out and guidance going down through the rest of the year, something that we've highlighted. I guess the tricky part now is with the inflation data, no matter how you cut it, seems like we're still going to be elevated pretty strong throughout the year. Could see maybe a turning point in like what the Fed deems as the most important for them, kind of that core PCE inflation without food and energy, although that doesn't matter as much for most people. But I think the next is just trying to see if you get this larger deflationary kind of bust that plays out, which is going to be more of a shocking event to the market, I think. And, it's tricky to say, even if you get inflation to turn over in some categories and start to deaccelerate, it's still going to be upwards of that headline number is going to be like 7-8% probably for the rest of the year. So still waiting to see, maybe more towards that end of the year transition into 2023 is where you might see a larger deflationary bust. But I mean, it all comes down to, you've seen commodities fall, but also rise and jump back up. So it really is just in terms of energy shortage and commodities right now, it's hard to tell when more of those less sticky items are gonna fall and turn over in inflation.
I think it's also worth talking about, and the dollar rules all in terms of the Bitcoin exchange rate, in terms of just global markets in general. It's the world reserve currency. But I mean, it's pretty shocking when you see, if you look at like the Dixie, the dollar index. I mean, the world's second and third largest currencies, by just in terms of just sheer size of the market, and in terms of the the euro is entire continent is using this thing, but the yen and the euro are just completely melting down, and that's obviously a result of central bank policy. But when you're talking about just like, I think people focus on the dollar a lot, and you could look at the BTC euro or BTC yen chart and it still looks terrible. I'm not really kind of coming from it like talking about it from like a Bitcoin perspective, but just in terms of what's happening around the world in these huge markets that usually aren't all that volatile. It's pretty astounding. And the euro's at, I think, 20-year lows. The yen's at 25-year lows. And eventually a strong dollar, if anyone's familiar with the kind of the dollar wrecking ball thesis, the dollar milkshake thesis, a strong dollar really kind of grinds the global economy to a halt, and eventually kind of throws the world into a recession just because of how much dollar debt is out there. And so, like, so many things are happening with commodities, with equities, with credit, with currencies, and Bitcoin's just kind of a small little drop in the bucket. And obviously is hyper volatile, is kind of beta on all these equities, but it's super insignificant in terms of just total size, right? What's really the seismic moves are happening in bond markets that are losing and gaining trillions of dollars of value in a day, in equities, which to a lesser extent are getting thrashed around. But these currencies, just the amount of volatility, and the amount of kind of turmoil that we've seen play out, and I think what's coming is pretty extraordinary, kind of from a historical perspective. And so, that kind of just, I am appreciative of where we are in the current macro environment, because it's truly historic, and I think it'll continue to kind of blow people away with how crazy things get, from all different perspectives.
I also want to go down this, fiat currency and commodities rabbit hole with the two of you for a second, if you'll entertain me. You have the Russian ruble trading at levels above it was at before the Ukraine invasion. In fact, just about 2 weeks ago, it was trading at 5-year highs. Um, you know, some just quick cliff notes for anyone who wasn't aware, but since invading Ukraine and being put under sanctions, Vladimir Putin came out and said, if you want to buy our oil or natural gas, I don't want dollars that I can't use. Pay me in rubles, pay me in gold, pay me in even Bitcoin. It seems as though the market has dictated and said this is actually a positive thing for the value of the ruble. Will this be something? I mean, we're going to speculate a little bit, so please entertain me. But is this something that other countries may want to pay attention to, may pay attention to, or what effect do you guys expect this to just have on the dollar directly?
Yeah, I mean, Sam and I wrote, and it wasn't really, it was kind of one of our largest like reports that didn't really focus on Bitcoin. I think it was February or March or maybe even April. I should know this, but we focused on kind of like the Ukraine Russia conflict and really what Putin was doing. And by no means are we like decade long geopolitical strategists. Really, we're just trying to have a finger on the pulse and see what's going on. But essentially, what we kind of from what the smartest people in the room were saying, and what we've kind of gathered was that Putin and the decision to invade Ukraine and the kind of the response to Western sanctions, it was less about territory, and it was more about kind of calling the bluff of Western financial markets in general, that were historically bloated, right? Western bond markets, Western equity markets. Putin and kind of what he's doing with global energy, and what he's doing with dollar hegemony, was like he's been biding his time for a long time. removing dollar reserves, stockpiling gold, and then saying, all right, Europe, like if you don't want to pay in rubles, then you can freeze to death and starve to death this winter. What you're seeing with Germany, which is like the economic powerhouse of Europe, kind of just in terms of if you look at Germany's size and global manufacturing, how they kind of have backstopped the euro as a currency block this entire time. The German bond market, just where those yields are compared to the rest of the eurozone, which for the longest time German bonds were actually held in negative yield because they were so much safer relative to Greek debt or Italian debt. Germany has gone from being a net exporter of goods and service of goods rather, manufacturing goods, to being a net importer because they've gone from a massive current account surplus to a deficit in just a matter of months. So it's pretty astounding just how much Putin and kind of the decisions that he's made, that the regime has made, have affected kind of Western countries, specifically Europe. And so the move to kind of say, hey, pay me in rubles for energy is not one that I don't think he's really too concerned with the dollar, or even you'll see some of the stuff talking about hey, like we're open to accepting cryptocurrencies. I think that's more of just kind of a blanket statement. It's really saying like, hey, we're the one in charge here, and if you don't want to play by our rules, then you can freeze in the dark because you need our gas, you need our energy. And that's what most people miss, or maybe not anymore, especially as you're seeing this really start to come into effect in Europe.
Yeah, and I think you just go back to those times, just adding on Dylan's point, is where, everyone's realizing after kind of this speculation bubble is coming down and consumer spending is getting hit everywhere in these eyes of inflation. It's all about, what do people care about most? Well, it's affordable commodities in your country, and politically, that's what you have to essentially sustain, is keep these prices stable. And to the dollar point before, being that you have this dollar wrecking ball, this DXY printing 107 on the index, 108 right now, is not just, the restrict or kind of easing from Japanese and European central banks, but it's also that those countries are huge net energy importers. And Europe's reliance on Russia. So you're kind of seeing this little bit of I don't want to use the word hyperinflating, but inflating currencies to those energy prices that are getting hit harder than the United States as well. So kind of just seeing this time where, it's hard to say from it, again, not experts in this field, geopolitical strategy, Russia, ruble, any of that. But it almost seems like pretty perfect timing of what was already primed and ready to push us into kind of an economic turning point. And now, essentially, as Dylan mentioned before, you're seeing a lot more kind of crises for the central bank start to play out, where you have European Central Bank now having to do this quasi-quantitative easing programs, or kind of roll out this new initiative where they're doing QE for parts of European Union countries, but not so much for the other ones, just to kind of help what might be a potential kind of like credit spread crisis that's playing on Italian bonds right now as well.
All of this, with record levels of inflation, and yet at the same time, you look at the Dixie and it looks like the dollar has never been stronger. What are you crediting this towards?
Yeah, I mean, it's the two biggest currencies in that measure are the euro and the yen. So it's dollar strength, obviously dollar strength against risk, not dollar strength against commodities or consumer prices or anything of the like. But the Dixie is really just measuring specifically. I think it's euro, yen, British pound, and so all those energy importers, Europe especially, they're basically having to decide whether they want to destroy their country with austerity to maintain the value of their currency, and freeze in the dark, or basically inflate, or potentially hyperinflate's a big word. I don't think hyperinflation, but really accelerate the inflation of their currency to kind of keep the EU glued together. It's a really ugly situation. And the Fed and the dollar, for how bad of a position, people say they're in, and that they may be in. They're actually, the U.S. is positioned the best out of really anybody in this kind of economic shit show, for lack of a better word. Excuse my French. So I mean, the Dixie is just indicative of a strong dollar relative to other fiats, but the long term is still just with global debt levels, with U.S. federal or public debt levels. There's no way to actually maintain austerity as a policy stance for long without the train completely coming off the tracks. So we've that's been Fed policy for 8 months or so now, since the November pivot, but it's not something that's sustainable for long. I really like Luke Gromen's framing of the Fed thinks they have a dial for monetary policy, but it's rather a switch, on or off. And right now it's switched off, and things are kind of unraveling fairly quickly. So the Bitcoin case, but really just in terms of risk assets in general, is that it's not actually possible for asset prices and this really entire hyper financialized economic system to kind of sustain austerity for long without everything, just kind of the whole house of cards collapsing. And so, I mean, obviously there can be a lot of pain. I think we're still have some pain ahead of us. But just in terms of the scale and the scope of it, they probably don't maintain that stance for long. When CPI crashes, when equities take another 20, 30, 40, 50% down, even all these things are on the table. Housing is probably the next thing to turn, the labor market, and that the response to actually get the can kind of kicked again, to actually get the ball rolling again will take a whole lot of firepower. And I think that's when the next kind of risk on move occurs.
I would only just add to Dylan's point on the dollar, the DXY. I really like Jeff Snyder's framing on this, that it's real. The DXY can see and show kind of like an economic bellwether sign of how things are going. And so when you have these massive spikes going on with dollar, not just other those currencies falling, but you have potentially this dollar shortage in the system that needs to be filled, and people moving to scramble at the same time that these other currencies are moving for energy reasons or going down for central bank reasons as well. And so I shared a chart with Dylan earlier that we were looking at, and it's just the annual change in the dollar and the DXY. So that being like 16, 17% now year on year change. And typically when you're getting over these 50 to 20, 25% really violent moves in just terms of how fast the dollar moves, can indicate that, here's a shortage in the market. The market is moving to try and get dollars for reasons that potentially, debt interest rates are liabilities are due, and those are coming, and people are scrambling those just because that's typically what's happened before. But those huge rate of change moves, kind of violent moves upwards, have usually marked a lot of different debt crises and speculative bubbles and recessions prior to that too. So, it's just can be a financial indicator of just the overall health right now of kind of people scrambling as the market and the macro is changing so much over the last year.
So we've talked about a lot of things now. We've talked about the Dixie. We've talked a lot about the potential CPI and the way the Fed is approaching their response. I do love Gromen's sort of analogy of it's not this dial, it's a switch. And unfortunately, they've switched it off and they don't realize it. You hear their narrative, and we've all heard a different thing Jerome Powell has said at one time or another of, we're targeting this for inflation, or it's this for unemployment. Sam, at the beginning of this conversation, you brought up that unemployment actually didn't come in at the expectations, and we might have lost a little bit more jobs. You hear it all over the tech sector, layoffs. We saw a lot of crypto companies going through it as well. Is there a specific economic indicator that each of you are paying attention to that may signal the Fed's reversal?
Yeah, I can kind of start. So on the jobs piece, essentially, yeah, although we've seen a lot on those curves, right, in like housing and tech saying those layoffs are coming through, I think from what I've researched and read before, those are typically kind of like the first shoes to drop when unemployment goes out first. And so it's still pretty positive in terms of in job openings right now, at least like above expectations, as those kind of fall off. And so, one of those things is you could look at job openings essentially right now, where it looks at a turning point where we're going to start to see those get hit a little bit harder. I think one of just the easiest economic indicator that has been pretty proven through the cycle and a lot of people pay attention to is just the acceleration and contraction of the PMI. So, right now we've had PMI that goes from kind of 63 across the manufacturing and services sector come down to 53, which is still a positive, kind of sign. Below 50 is when you get into real contraction territory. And so from like all previous cycles with these huge economic turning point cycles, you really see PMI as a kind of purchasing manager index, this index of this survey of people going out and trying to understand of people who are making these kind of microeconomic decisions. What are the input and labor costs? What does employment look like for them? What is the productivity that's happening? A lot of metrics that go in there. So typically you see that as a leading indicator of where we're heading next. So we've been on this deaccelerating trend through the cycle. And typically where you get the most kind of pain in financial economic cycles is when PMI goes below 50. It's deaccelerating in that 40 range. And then essentially like you're looking for a turning point after all that economic pain has gone out. So that's one in particular I keep kind of close watch on. I think job openings relative to expectations. A lot of the unemployment metrics now are going to be interesting to watch as the Fed, like I said before, is essentially wanting unemployment to go up. So I think before they even try to stop tightening or reverse that, they're going to want to see unemployment jump up at least by another % or so. So those are good ones. Small business index for optimism and sentiment is nice. That's from NFIB. And then, we've talked about consumer sentiment as well, kind of reaching all-time lows just over the last couple of months. So those are some of the ones that I kind of put in a bucket and pay attention to a decent amount.
You want me to? I mean, I guess we've covered it a little bit, but just in terms of like, economic stress, the Dixie, if you're looking at the bond market, which is, the kind of the big mover behind the scenes, bond market volatility. If you have TradingView, just look up MOVE. That's at highs. That was basically peak coronavirus. So, the biggest market in the world has, the liquidity that it had, is moving like it did during peak drawdown, March of 2020. The VIX is a lot lower than that, but I certainly think that the VIX, the equity market volatility, soars higher. In terms of Bitcoin, we've seen, probably in absolute terms, we've definitely seen the largest capitulation event ever. In relative terms, it's up there. In terms of, I think March 2020 in relative terms was more severe, and it's happened a lot quicker. But just if you take, total open interest across a lot of these, futures, derivatives, contracts, and what we can't see, what's not transparent, like the open interest statistics, is the kind of the off balance sheet or the balance sheet stuff between the creditors, between the lending platforms, all of that. If we just kind of just take all of that, put it together, and just look at the forced selling that's occurred, we've seen a massive capitulation. Like that's already occurred. The question in terms of where Bitcoin bottoms, and the reason we're talking about currencies and bonds and credit spreads and all the like, is that it's very, very hard to say, hey, Bitcoin's bottomed 17.5 or whatever it is, 20K now. That's the bottom. We're going to stagnate for a while, but it's up only from here, when the worst has probably soon to come, or hasn't yet occurred in legacy markets. It's basically impossible for Bitcoin to catch a sustained bid. If we see equity market volatility increase, if we see, the NASDAQ, the S&P 500, take huge moves lower. And so, Bitcoin has, for better or worse, never seen a recession. And so, there's just a lot of factors, a lot of variables at play here, which is why, I think from a capitulation standpoint, we've seen most of the kind of the downwards move, whether we go from 75% from the highs to 80 or 85%, I mean, that's certainly possible. But I think what people aren't prepared for is the capitulation that is yet to occur is a time-based capitulation. So we've seen the price-based capitulation, at least the dominant majority of it. We could certainly go lower. I mean, 15K, 10K. It's always possible for Bitcoin to draw down another 50%. Like, don't rule that out. But the real pain is that now we're at $20,000. You have miners at hash price near 2020 bear market lows. They're going to be forced to sell more of their coins. Retail interest is obviously not here. The plebs that arrived in 2020, or really anybody that's been dollar cost averaging over the last 4-year period, they're underwater. So there's a whole lot of kind of things that have never really happened before at once in Bitcoin's sense that are all occurring at once, which is why max pain. We felt a lot of it, right? The market's absorbed a whole lot of selling, but in terms of just calling an absolute bottom, and by no means are Sam and I, so-called like the oracles here that are going to call the bottom, at the exact tick or the candle wick, but just it seems, just based on all the things that we're looking at from a macro view, it'd really be hard to say that the generational lows of Bitcoin are in. Would I be pleasantly surprised? Yes, but just don't just a little bit of realism from our end in terms of saying hey, it's probably a little bit more pain to come, whether that's time based or price based. In a move lower, we've yet to see.
I wish it went without saying, but as a very direct reminder, please do not take anything being said here in this segment or at any point on today's show as financial advice. Do your own due diligence. If you're listening to a bunch of talking heads online and basing all of your financial decisions off of that, you're a fucking idiot. So do your own due diligence. Look, I'm a little disappointed, Dylan. I did expect you to tell me the exact, all the way down to the sense of what the Bitcoin bottom is going to be. So a little disappointed that I can't ask you that question. What I will ask is just sentiment for, all right, just bear with me because I'm going to ask you the stupid question that you hate me asking, but you brought it up at the beginning that we've seen this correlation with the markets and there hasn't really been any inclination that we've broken that. Can you give an example of what a sign that the correlation between the equity markets and Bitcoin has broken?
Yeah, I mean, I think necessarily that the correlation is not going to disappear, or I think it remains for a long time. Bitcoin is just kind of like everything, for better or worse, is a function of the liquidity tide. It's just a matter of what performs best. Bitcoin performed best this last kind of credit cycle. I expect the same the next credit cycle. And I think the moments of decoupling aren't going to be something that occurs over a 6-month period. It's going to occur on a daily time frame, or over a couple hours, where Bitcoin is up 25% because everyone is squeezed from shorting it, and equities are doing nothing. Like, we've seen that in Bitcoin's past. If you look at the break from the last range from the bear market, Bitcoin's at $3,000 for 4 to 6 months or whatever it was. All of a sudden it pumps 35% in a day and triples over the next month, right? Like, these are that regardless of what the equity markets did, Bitcoin was pumping like crazy. And so I think in terms of decoupling, that's what's probably going to take place. Kind of Sam and I are of the opinion that after the brunt of the spot selling has occurred, whether that's today or a couple months from now, or whatever it is, it could be a lot lower. It could be at 15K, 10K, whatever it is. You're going to see a lot of the derivative market short Bitcoin into the ground. The bears have killed it over the last 8 months or so, and have done really, really well shorting it. But shorts like to pile on at the bottom, and every really kind of macro Bitcoin bottom that we've seen is characterized by persistently negative funding, futures, and backwardation. So, like, say the August or September 2022 Bitcoin futures contract is trading below the current spot price. You see just like all the shorts pile on in futures, and you kind of see from there, like, the huge moves upwards from the bottom of all the bear markets, say like, if we're going back to the 2019 example when Bitcoin is at 3.2 and it shot to 4,800 in a day, right? Like a 25% move upwards or whatever it was. That wasn't like a whole bunch of spot buying. That was a mechanical move, and it was shorts actually covering. So like really no one bought spot there, or like, not significantly more than they did for the past 3-4 months. The move was a whole, tens of thousands of Bitcoins worth of short interest that had to force buy higher. So I think that's probably what you see when you're talking about a decoupling. That's where Bitcoin decouples for short periods. But I think it's quite natural that Bitcoin is kind of like a functioning as a quasi equity instrument. It's a debasement hedge, similar to equities. It's like, and that's different, I should say, than an inflation hedge. People are like harping on, hey, Bitcoin's not an inflation hedge. I don't think it ever was. I don't think it ever was a year-over-year CPI inflation hedge. Bitcoin and kind of the year-over-year change in rates or the year-over-year change in inflation is not a great relationship. What Bitcoin is a debasement hedge against perpetual monetary expansion. In my opinion, it's an alternative system. And so I think, even if it's correlated with equities, equities are, in nominal terms, I believe, going to continue to melt up, even though we're 30% or 20% off the highs, just based on how our system functions. The fiat monetary system requires credit expansion to sustain itself. So Bitcoin being correlated to equities isn't a bad thing when equities melt up, a majority of the time by design, right? I guess that's just my 2 cents.
I always love your 2 cents, and thank you for entertaining me with that response, Dylan. I know how much you hate when I ask that question. So I want to talk now a little bit more about just what you're seeing on chain. If there's any figures or any numbers in particular that are causing you concern or excitement. And I'll go first. And one number that was shared last week was the amount of Bitcoin that moved off of exchanges into cold storage wallets in June was a record, I believe. I say this in front of the two of you in hopes of either being validated or being called a complete buffoon for saying that. But these sound and read to me like a very positive sign that the ecosystem, the network holders are doing the things that need to be done, and price does not matter. Everyone's taking the right steps to move us forward. Are there other such things that you guys are paying attention to that are actually, further validating your belief in the underlying thesis that Bitcoin is the best and soundest money out there?
Yeah, I mean, that exchange balance statistic you referred to is correct. In month over month terms, I believe it was the biggest month ever. And I don't have the number off the top of my head. I believe it's like 100,000 Bitcoin or so that were taken off exchanges over the trailing month. I think it has less to do with market exchange rate pricing and more so just with the kind of the contagion we saw, right? It's just like a bunch of counterparty risk. Why even risk having any value on exchanges? And so that's a good sign. It's positive. I mean, over the long term, less and less Bitcoin on exchanges, on the margin is good for the exchange rate. On the shorter term, I don't think it's all too significant. In terms of other on-chain metrics, and I'll hand it off to Sam in a sec, but I think one of the ones that we like to cover, it's very, very basic, and it's just a great kind of map of the Bitcoin cycle. The bull and bear cycle is the realized price. It's just the average cost basis of all Bitcoin holders. You see during a bull market, the market price is 2 or 3 or 4x larger than that kind of that average cost basis. And during the depths of the bear market, it actually falls below it. So the average holder on aggregate on chain is underwater, and we're there today. So that average price, that realized price metric is at 22,000. Bitcoin's at 20,000. So on average, the average Bitcoin via the price it last moved on chain is underwater. And so we've seen that with every single bear cycle. That was around 4K in 2019. And the realized price continues to just kind of bend upwards with every bull and bear market, and the hodlers distribute at a loss or at a profit, right? So very natural. Like, I mean, in terms of like if we strip away all the macro stuff, right, and if you just looked at the data, if you just looked at the Bitcoin chart, the drawdown from all-time high, this is like a pretty standard Bitcoin cycle. It was kind of different in the sense that there was a double bubble from 60K, drew down to 30, went to 69 again, and then fell down to 20. But in terms of the mechanics of a Bitcoin market cycle, it's not all that different. We just have kind of a different backdrop. So I guess that's what I'll say from the on-chain side of things, but I'll let Sam hop in here and give his input.
Yeah, thanks. I mean, to the exchanges point, I don't think that's obviously not a coincidence. I think it was like Dylan said, 100,000 is probably like 120, 130,000 Bitcoin that left exchanges over kind of like a 30-day sum, or you can also look at it just as like the month of June. Definitely was like the top historical month there. I think as for price goes, I think we've written some pieces before and put some information out there. It's hard to see exchange balance having like this short-term price effect. So I think people get, excited about that and thinking that there's going to be some price rise. I think it's just more of a telling trend of where Bitcoin is going, and an assumption for a long time has been. I think it's a good one broadly to say, hey, likely some of this or majority of this is going to some other custodian or long-term storage. There's also other products on the market that are non-exchange Bitcoin that Bitcoin winds itself up in. You can see stuff like that in like wrapped Bitcoin on other chains as well. It's got kind of 240,000 out there, I know, just on Ethereum. So there's other places where that ends up. So it's not all going to cold storage, but I think it is telling sign of that is the highest outflow month while this contagion happened. I think in terms of like how I look at a lot of on-chain metrics right now and trying to think about them is, one, I think you have a lot of the classic kind of like cyclical or mean reversion metrics that people have cited before. So MVRV or like MVRV Z-score, kind of that price over realized price Dylan was talking about, is a very popular one. You have activity, essentially like the value of the network relative to activity. You have some reserve risk, which is more of kind of like reserve or maybe like risk allocation of right now. Should you allocate or should you not, based on what holders are doing? So if you look at all those, they're like very low percentile, very low cyclical kind of metrics right now, would tell you that right now, relative to these trends, relative to the few cycles we have, which is small sample size, that Bitcoin, if you're looking at a 3, 4, 5-year time horizon, is incredibly pretty cheap. But I think with Dylan's point on the macro side, ones that I lean into a little bit more are kind of like looking at duration of what we would say like capitulation is. So we obviously had some capitulation signs, some forced sellings, the liquidations, and kind of you can see some of that in on-chain. So one of those is looking at kind of the net unrealized profit and loss on the market. So you're looking at the percent of how much of this Bitcoin from holders is at a loss now. So, when you have something of like 30%, or the Bitcoin that's being held is at 30% at a loss, that's kind of this capitulation type event that we kind of gone through. But there's a duration component, as Dylan mentioned before there. You kind of have these one-off events, but a lot of these bear cycles are drawn out. If we hit lows, we can hit lows again. We can hit lows below those. And I think the biggest thing for me is kind of looking at the long-term holder cut of on-chain and saying, of the people that maybe have been in for a few years, a couple of years holding their Bitcoin, I think on net, their average price is around 22,000 right now. So we've only seen price sit below that average price for a very small amount of time. And typically in bear cycles, we see a long duration of that. We see price it below their cost basis of the network. Just kind of telling me that it's possible here that long-term holders, people have been around for a little while or holding their coins longer than 6 months is the kind of technical definition from Glassnode, is that maybe there's not enough pain felt here that has been in previous cycles before. Obviously that can change cycle to cycle, and there's only a few cycles to compare, but that would tell me that there's like this duration component that, maybe people are tending to kind of feel a little bit more pain here. I think there's the kind of relation as well. We saw some larger miners selling a decent amount of Bitcoin over the last month. I saw an interesting point today from Joe, which is at II3 Capital on the Blackware team. He had put out kind of an estimate that a lot of pain could be sitting at for a hash rate around the network at around 10,000 right now too. So just an interesting price point. I tend to look at, kind of the duration component of these bear markets, and in a lot of way you cut it and look at it, just seems like there could be a lot more pain ahead, or at least this could be drawn out whether we hit the lows or not. So I would just prepare people for that scenario.
So I worked on phrasing this so it's not a speculative conversation. We've talked at this moment about how there are a lot of people underwater, a lot of people buying Bitcoin all the way up to 69K, myself included, riding it all the way back down, continuing to stack. But it's not just individuals. You have publicly traded companies that also bought at certain levels and are now underwater. Two great examples are MicroStrategy, that started buying as early as the summer of 2020, but with their add-on buys is now underwater, or a company like Tesla, with their initial purchase being completely underwater at this point. Unfortunately, not every single one of these publicly traded companies has a CEO with the same amount of conviction as most of us do. There is a possibility that Tesla board turns around and tells Elon, like, this Bitcoin experiment, no more of this, be done with it. What effect, if any, would the market would something like a Tesla unloading their Bitcoin holdings have on the market and the confidence of Bitcoin? Price obviously would get hit for a little bit. But
Yeah, I mean, Q, I think you could probably answer that, man. I mean, it'd probably be bad, like in terms of the exchange rate, in terms of Bitcoin's track, or what it actually the network is doing. It would have no impact. Blocks would continue to be mined. I think just in general regarding like public companies or institutional interest in the space, there is long term. We're gonna be fine. Not we, I guess, just Bitcoin is gonna be fine. It's gonna continue to work as designed, and the kind of the game theory and your own self interests around an absolutely scarce monetary asset will draw people in. But there is a pretty severe problem with just over the last 2 months with the amount of, just being blatant, and we've covered this, like, I think the last time we talked, Q, on Spaces and on YouTube, just about the legitimacy of this space and the amount of sheer fraud and honestly like Ponzi's around the space. Obviously, that's not a knock on Bitcoin, but the actors around Bitcoin and using Bitcoin, right? If we're looking at Celsius, it looked as if, based on the lawsuit that came out, that they were legitimately running a Ponzi scheme. They had liabilities denoted in ETH and other cryptocurrencies that they just didn't hedge. They were speculating in DeFi land, and had liabilities denominated in things that increased by an order of magnitude and had to cover. And so they, basically starting in, I think around early 2021, Celsius was running a Ponzi scheme. The whole Luna UST thing, with all the so-called experts in the space championing that, taking their treasuries in UST, investing in Luna, right? Everyone knows the infamous Novogratz tattoo. So I guess what I'm getting at is the so-called smart money in the space has pretty big black eye on their face over the last couple months, and so from an institutional perspective, when we're heading into a recession, anybody with a brain and two eyes can see that a recession is coming, and global economy is not in a good place and is continuing to deteriorate. Interest in Bitcoin, which despite what a lot of the people, including myself, champion as being the best money ever, have been having the best monetary properties, and over the long term being just a superior monetary asset compared to any other currency or asset on the planet in human history. The reality is it's served as basically NASDAQ beta with added with added risk of illiquidity to the downside. And so from an institutional perspective, in 2022, summer of 2022, you don't obviously the plebs and anybody that's on an individual scale, or that owns a small business, or say there's another Michael Saylor out there with a publicly traded company with all the voting rights, you can do what you want, but from an institutional perspective, from a board perspective, companies aren't going to, at least for the time being, until there's some regulatory clarity, they're not touching this space with a 10-foot pole. And that's great for anyone that's looking to stack cheap sats, keep the institutions, keep the suits away, no ETF, etc. Right? Like, soak it up and stack 20K Bitcoin. If it goes lower, great. But in terms of like, the quote unquote sophisticated legacy participants coming in here after Celsius, Luna, UST, Three Arrows Capital, Voyager, the list goes on. It's just not happening. So like, not to be a pessimist, it's just, that's just the reality of like, these legacy participants coming in here and stepping in when they're having, to be told to go risk off in the legacy world. Never mind, entering a position on a 80 vol asset like Bitcoin or whatever it is. So whether it's MicroStrategy or Tesla or whatever their cost basis is, or they're underwater, I mean, sure, like, there could be another publicly traded company that adds some more Bitcoin, but the accounting rules aren't favorable, and just there seems like there's a whole lot of just kind of regulatory uncertainty. And for someone like me, like, I don't care what Gary Gensler says about Bitcoin. I'm gonna buy it. I'm gonna hold it. But for someone that's has to respond to shareholders, has to respond to a board, etc., like, it's just not a great time or optimal time to be allocating to the space, even if it's in their interest in the long term. So long-winded answer, but that's what I kind of believe.
You were flatly wrong, and I could not have answered it as well as you. So, boom, there you go, Dylan. Before we wrap up, I do want to give you guys each a moment to just share anything else that you guys are seeing or paying attention to that we didn't get a chance to discuss right now.
I guess I can wrap it up with saying that we're covering more of the stuff that we talked about today in our daily research. Bitcoin Magazine Pro, we kind of just put like visuals and kind of graphics to some of the stuff that we've been talking about over audio today. So if you're interested in that, check it out. And appreciate everyone tuning in. I don't really know if I have any more to add, but I'll turn it over to Sam.
Yeah, no, I would just add one more kind of thing. I think probably the most interesting thing right now in the space, and where we're going to be trying to maybe put a little bit more research efforts in over the few weeks, kind of digging more into balance sheets, is kind of where these public miners land in terms of some of the debt they've taken on in their collateral with machines, collateral with their Bitcoin. Kind of looking at some of these monthly production updates, kind of month on month, seeing what happens here. I think maybe we've seen like the start of some minor capitulation at some level. Now, again, we're going to see kind of the duration of price play out and how long kind of some of the miners in the network can withstand this. Because I think right now at the turn of the year, a lot of people were hoping for or forecasting a 300 exahash in hash rate, and we're at although up on the year, I think 20-30%, we're about 205 right now. So I think the next big thing is seeing how much hash rate potentially comes offline from kind of capitulation on the network right there and a shakeup of things. So definitely going to be covering that more. Like Dylan said, check out bitcoinmagazinepro.com if you want to sign up as a free sub to check out some of our research once or twice a week.
Cannot overestimate this enough, but if you are someone who does pay attention to the price on a daily, if you check the price on a daily basis, you should be subscribed to Bitcoin Magazine Pro, because there's no better people to break down what's actually going on and separate the noise from the signal for you than these two gentlemen right here. So it's a free subscription. Do it. Just do it. And while you're at it, make sure you subscribe to the YouTube channel.